Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 7th of May, 2020. And we're talking before the jobs report on Friday. What to do, how to prepare, and how to step outside of this volatility box. We'll start with the S&P 500, which is trapped, as it has been, just into this 2900, really a little above that, and about 2850. We talk about the murder hornets and how those are now a plague. This feels like the same thing in the S&P, which this is a murder hornet zone. And that's again the 2850, just above 2900. Any type of rally has been murdered as it came away from this. And same type of thing in 2018, a couple times in 2019, and then it went the other way. This level became support until we crashed through. So not only is it the middle point of this 3400 to about 2200 drop or corona crash, it's just a critical spot. We can see that play out again in the weekly chart. Let me actually make this full screen and get our thoughts onto this topic and what to do next. Mainly, it's just a consolidation spot where, well, same thing here, 2018 twice and a couple times in 2019. So that's just a little gravity spot, if you will, the larger magnet. Maybe magnet is a better word, but there's a really equal chance of going up or down. How can we support that? Same type of thing with our implied volatility or the probability of expiring cone. And taking a look at it, we see how the market, we actually might do the SPY because we can talk about some other option chains. In terms of implied volatility, it has gone down. The ADX is a trend-based indicator, such that when it goes low, which is about 15 to 20 on the daily chart right here, that precedes or goes before a range expansion move or a breakout move or movement into a higher volatility environment. That's going to be similar into the ATR, which is your average true range, just a measure of volatility, daily highs and lows, and our favorite indicator, which is implied volatility. So all these hit lows midpoint of February, and the S&P cracked and really made a big beeline for the downside. And you can see how this plays out multiple times, and that's where we are again. So the ADX pushing under the 20 bound once again. The average true range remains a little bit higher, but the implied volatility, let's actually take that off the chart just for a comparison. And the implied volatility, not down to where it was, but it's still lower than it has been. And our probability of expiring cone takes us all the way up or down. And you can see how that plays into March, or not March, but to May, June, July, and beyond. And these curves are helpful, but aren't predictive. They're just talking about the implied volatility based on where we are right now and how that plays into it. It's essentially this. Don walks us through this type of logic, which is the implied volatility chart here, days to expiration, and how that translates. Both, I mean, implied volatility, sure, but the actual price numbers up and down as we go forward. And that's what that chart there talks about. Can be done in the SPX, which has similar type of grids and information, implied volatilities, obviously the QQQs, and really anything else you might want to look at. Here's the SPX, and that talks about 150 some odd points into May and beyond. Just a measure of volatility, and specifically there's roughly a 70% chance that the market will trade within this zone within the next few weeks. Now, when you have low implied volatility, that curve is going to shrink because implied volatility shrinks. And therefore, when the market does go range expansion, either to the up above 3,000 and a beeline pathway to the high, defying all the news, logic, and everything else, but still can't predict the future, have to be prepared. Still think a lot of people believe, expect, and I'm right there with you, that the market has a better chance to go back to the lows. And the implied volatility being compressed might be a good time to put on some calls or put positions, whatever your thought process is. If you think the Fed's going to bail us out and all is going to be okay, this is your spot to go long calls. But if you're like the majority, we think this is going to be this far and no farther, not beyond this 3,000 print. You've probably already got your puts purchased, your verticals, and any other type of long volatility strategy. That could include, of course, the VIX itself, which we'll take a look at in tonight's video. So the VIX, just look at the VIX index. A big spike up from the 15, really almost, well, back to here, 12, 13, 14, stable print. That all went off the rails in the Corona crash to 85 and then steadily back down. And Don makes the point to remind us that volatility, despite the market going pretty much straight up, is not back to where it was. So there's still a little more elevated volatility in the market, and that just brings us right back to these lows. So again, just all we're saying is that the market's compressed at a volatility box range and a spot that 2,900, 2,850 thereabout has been a critical pivot point in the past. Probably will be so into the future, which is into next week. Now let's take a look at our calendar once again. Now we are Thursday. We have the jobs report on Friday. And that's going to take us into right here. It's kind of hidden. And by the way, how do you get here? Market Watch, calendar. Take a look at the weekly point of view. Monthly works just as well, but the weekly point of view right here on the 8th of May, tomorrow. And there we are. So we can take a look at the double click, and that's our jobs report. This is expected. We will know this in the morning. By the time you hear the video, we'll have this 1 hour before the market opens on Friday morning, and 1 hour before Don is talking to us about the report. More so the numbers. We're concerned about what the S&P does pre-market. So this, it's easy, especially as a new trader, to come in and say, oh, believe me, I'm right there with you. 21 million Americans lost their jobs last month. The unemployment rate is going to spike, expected to spike from 4.4% to 16%. We think there's just no way possible this market can rally, but if you've been around long enough and see any type of earnings report, XYZ company missed their earnings. They missed it by a couple of pennies. And so we think the stock's going to plunge, but no. They gave good guidance and the market goes up. So we just don't expect surface level logic, I suppose, to play out into Friday's session. I guess that would be nice if all the negative news turns into negative prices in the market, but I've been around long enough to know that's not the way it works. But anyway, we know this in terms of how the Thursday jobs reports, and that's kind of been our joke, perverse little gallows humor joke, is that the initial claims for unemployment comes out each Thursday. The last few Thursdays have resulted in massive spikes in new claims for unemployment, which is people laid off from jobs, furloughed, or etc. And the jobs report, the non-farm payrolls, the first Friday of the month, that's going to tally north of 21 million jobs. But the market could go higher. So we will watch that with carefully manicured, I guess, accounts and an optimistic, as best we can, point of view. And again, it comes on Friday. So as we do that, as we turn you loose after tonight's video back into the market here, all things being considered, we can maybe take a look quickly at crude oil, which fell during, again, the Corona crash from 60 per barrel down. If you remember, one of those contracts, near-term contract, went negative. If the rolling contract stopped at 5 per barrel, it's now upwards of 25, 26. So that's where crude oil has bounced and recovered. And gold is taking its little bull flag type of bounce, a little bit long type of plays off of just under 1,700, so say 1,685, 1,680, 1,690. That leads to a bull type of bounce swing trade. And again, we're seeing a bull flag or triangle break, which does signal gold could go back to the highs. And that makes sense from a logical standpoint. I don't want to try to put too much logic on the markets, but if the unemployment rate does hit those levels or maybe even exceed them, it's negative, but it also means the Fed is going to bail companies, corporations, and the American taxpayer. Maybe the Congress will do that too, and it essentially means more stimulus, which means more inflation, which means gold is going to go higher. So These are things to watch beyond the equity market. To what extent does the Fed step up, print more money, essentially, and do their quantitative easing, or the Congress bails companies, individuals, taxpayers out? Those are inflationary models that may send gold higher. Either way, and of course the bond market too. Taking a look at how these all play together within this framework of supply and demand, levels, expectations, and of course, at the end of the day, the positions that you have on and how to manage them if there is a major surprise. That's what risk is. Just protect yourself from unexpected developments. Spreads do a really good job with that. Infinity, risk twists, verticals, and outs, all those will be your friend. As always, take care and be safe. This is Corey Rosenblum with your Theo Nightly video for May 7th, 2020.